Welcome to Centennial Advisors. We use our cutting-edge technology and collaborative client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon and welcome. My name is Justin White. I'm the managing partner of Centennial Advisors. Today is October 13th, 2022, and I'm joined by Jason Brooks of Buckhalter, my co-host, as we do this informational webinar/podcast discussing the commercial real estate market, not only things that are happening in Southern California, but issues affecting investors across the country. We're delighted to have you join us for the next hour. We're going to talk about a variety of topics. We've got some legislative issues in front of us in the next month that we'll address as we start. And then we'll work into a little bit of an update on not only where the market stands and what is happening, but also the opportunities that we see today for investors going forward. So it should be a good, quick hour, exciting. We'll cover a lot of different topics. We may even get into some opportunity zone stuff, which is, I think, one of Jason and I's favorite topics that we've covered over the last year and a half. I think we've ultimately helped people pay close to $50 million in opportunity zones and shelter a significant amount of money and avoid future gains using opportunity zones. So we may answer some questions on that based on the experience of some of the transactions we've done. But Jason, get right to it. Let's start on the legislative front and the things that you're seeing both in the legislature, but also maybe law changes or legal cases that you're seeing that are setting precedent as it relates to commercial property investors in Southern California. Where do you want to begin?
So let's start with this new ULA proposal, which is an LA County proposal. And many of you have probably heard of it. It's the sales tax proposal now on real estate. So the proposal, which will be on the ballot in LA County in about 3 weeks, states that if you are a property owner and you sell a property for north of $5 million, which in Los Angeles County would be a substantial portion of the properties, you would pay an additional sales tax of 4% of the purchase price. And if you sell a property for north of $10 million, you'll potentially pay a sales tax of 5.5% of the purchase price. And so that's one of the big ones, I think, that has a lot of people concerned right now, because it would affect such a large portion of the properties in LA County. And keep in mind too, they say that the money's going to, help and create homeless housing. If you top that off with, the other parts of it, they say that they're only going to spend, 6 or 7% on administrative costs. So, and they think it's going to generate roughly up to $1 billion a year in tax revenue to assist the homeless housing project. So that's, I think, Justin, the first big one that we're running into. I don't know if you've gotten calls yet at Centennial about it, but it's something that people are really getting concerned about.
We're starting to hear a little bit more talk of it, especially. I would say that there's not a ton of investors that are actually aware of it, especially those people that own in LA but don't reside in LA, and what it could mean for the sale of their properties and the tax there. But Jason, let me ask you a question that might be on everybody's mind. With Prop 13, let's call it our property tax is fixed. How can they just add a tax as it relates to the sale of our property? How's that done?
So this is.
Go ahead.
No, I was just saying this is just a sales tax. Like if you buy or sell any product, right? Like if you go to Santa Monica and you want to buy an iPhone, it's I think 10.5% now tax, right? So they're just treating this as a general sales tax. It's not a annual real estate property tax. It's just a sales tax on the transaction. So If you don't sell, nothing happens. And I'll be honest, this was actually brought to my attention first by some high-end residential brokers that were really concerned about it. And then when I started digging into it, I found out that it applies to all property. It applies to anything from a single family home to any commercial property that there is. And so this is something that if you start to look at the math, let's say on the commercial side, the brokerage commission is, or the residential 5%, right? So if you sell property for $10 million, you've got 5% commission, you've got 5.5% tax. Now you have the, documentary transfer tax, which is 1.25% in LA. So now you're up to, 11.75%. Then you have, title and escrow fees. You're looking at transaction costs between probably 12 and 13.5% of the actual property value. So that's, really starting to make people think about, well, what do I do? Should I sell now? Should I, try to lock in my value? Is it higher, if I don't have to pay the tax?
So follow-up question, we've got a couple of them. With the new sales tax, when does if passed, when does it go into effect?
They're talking about it going into effect in January of next year.
Okay. And so it would seem like people that might own in LA now could, at least in the short term, and we've talked about this in the past, how things start in usually LA or San Francisco and make their way into other cities, at least for the time being, move equity out of LA City, because it's a city thing at this point, and then move equity into Orange County, Riverside, San Diego, out of state, whatever it may be, to potentially avoid that.
Correct. So everything seems to start in LA and trickle out, right? We've talked for a long time that only, San Francisco and Los Angeles had rent control, and then Santa Ana has rent control now, right? And then, we'll probably dig into this a lot more in the next couple minutes, but, it begets the question, do other areas start to add rent control? So I'll give you an example, though, of kind of how things start to spread. Riverside hasn't had an affordable housing requirement on new developments historically. They just passed last month at the city council level a 10%, all units on all new construction have to have 10% affordability. So if you build 10 units, one of them has to be affordable on new construction apartments. And that's something that's been going on in other cities and other counties for a long time. And it's just starting to continue to spread out to other locations.
So Jason, what have you advised some of your clients, not necessarily the residential brokers that you were working with, but some of your investor clients who own in LA, maybe the larger investors? How are they strategizing around this? Are they quickly trying to get properties to market to beat the sales tax and then redeploy into other areas? What are you hearing?
So a lot of people are really sitting down and contemplating. The larger clients, sometimes their margins on deals are, 15, 20% when they sell, that's their profit. Well, if, anywhere from 25 to 33% of that margin gets eaten up, especially with the moving interest rates, a lot of them are starting to put deals on the market to just see if they can, lock in their pricing now and then reposition outside of, LA County, potentially into other counties in California, mostly because California rent growth has been strong, or they're looking for, properties out of state that they'll reposition themselves into on a go forward basis. There's, we talk through some strategies with some clients about, I sell my LLC interest and how does that work? And sure, you could do that, but then you can't 1031 exchange, right? So, you're just paying capital gains for selling your entity interest in the deal. So that's a different tax bracket. But then also there was a law passed in California recently that was upheld that if you sell your membership interest in a company that owns a property, you're responsible for the 1.25% documentary transfer tax as well to the county if they find out that you sold your membership interest in the entity. So they're still going to get you on some of the taxes. Presumably, if you do that, LA County will try to imply, or LA City will try to imply the same valuation or the same legal concept on the transfer tax as they do with this sales tax.
So real quick, Jason, there's a lot of places in LA that are neighborhoods that people might not feel like they're living in the city of LA. Is this applies to any place that is city of Los Angeles, Wilmington, Harbor City?
Yeah, incorporated city of LA. So you're looking at Westwood, you could be looking at Brentwood, you would be looking at Bel Air, Culver City, all the areas in Mid City. On the other side in the Valley, I'm not sure. I don't know if Encino ever incorporated, but like Studio City's unincorporated, North Hollywood. So you're looking at a lot of areas that are all, LA, incorporated LA City. I keep saying within the county. I think that as soon as LA City passes it, LA County is going to take its swing next, because they tend to go hand in hand on their decisions. So I think you'll see it pretty quickly behind that.
Okay, we could probably talk about this most of the hour, but let's move on. If anybody wants to reach out to Jason or I and talk more about it, strategies, learn more about it, we've got some great information and we'd be happy to talk with you more. You had mentioned Santa Ana a moment ago, as we talked about, first it was LA and San Francisco that had rent control, and then Santa Monica and West Hollywood. And Santa Ana was the first Orange County city before 1482. Or at least Santa Ana is the most onerous city. Why don't you talk about that for a minute? Because we've actually talked to a lot of people in Santa Ana that some of these policies are starting to get to the point where enough might be enough.
Right. So what we've seen is Santa Ana last year, at the end of the year, passed citywide rent control. What most people don't understand about how rent control got passed there, though, was it only took a vote of I believe it was 5 council members to pass it. They needed a 3-2 vote or a 4-1 vote to pass it. So it was just a decision of 5 people. It wasn't the decision of all the voters. Just those 5 folks got to make the decision. Once they made that decision, it was implemented starting January 1. They didn't think through a lot of the application and didn't have the same sort of staff that LA City has, but they pretty much almost word for word copied the LA City version of rent control. And so now a lot of the questions that we're getting is, what happens to Anaheim? What happens to Costa Mesa? What happens to the places around it? How do we, do we know if it's coming? And I guess my first answer is you have to look at the makeup of your council, right? Your city council, because they're ultimately the ones that are going to make the decision. But I wouldn't say that it's far off in certain places to have that, come through. So I think that you're going to see some other cities in Orange County start to have rent control as well.
Okay, great. Before we get into what we're seeing happen in the market, and there's been a lot of change over the last couple of months as interest rates have increased. Let's talk. I want to get your take, because not only do you advise a lot of our clients on the structure of their entities and how to do some pretty creative things with estates, but you also have your finger on the pulse of construction because you work with a lot of developers. If you could give us a minute on that, because there a lot of, let's call it, opportunity is that, on the multifamily side, you could put an ADU, or there's new legislation that says you can, maybe build more density than you could before on any property, commercial property or even a piece of residential property. But talk about what you're seeing there from a time standpoint, cost standpoint, kind of all the things that you're hearing and seeing, and what kind of your advice would be to somebody who might be considering taking on, whether it's you or converting a retail property into 42 unit multifamily, or taking a vacant piece of land they own down by the port and building an industrial property on it. Talk a little bit about that.
So my recommendation, especially right now, is if you're not a developer and you're not used to building, getting into it is going to be very difficult. Why do I say that? The cost of construction loans has gone up substantially. So your your capital costs are higher. Things are taking, for most of my clients, about twice as long to build. And these are professional developers that they do this for a living. The reason that it's taking longer, there's a labor shortage. There's supply shortages still, the things we saw during COVID carrying over. And then costs are going up substantially. You're seeing rising costs still in material, rising costs in labor. People are having, a hard time getting firm commitments from, their general contractors. They're having, I'm still hearing that, quotes on certain materials are good till the end of the day, right? And if you don't pull the trigger today, the price is going to be different tomorrow. And so I think if you have a very good general contractor that you trust and believe in, and then you can execute still in an efficient manner, but it is more difficult than it was. It is not as easy. It's taking longer. But remember, when it takes longer, it costs you more on your capital cost for your construction loan because you're still paying interest. So that time costs you money. It doesn't just cost you money because you're not making money off the rent. It costs you money because your costs are continuing to go up. So I would highly recommend either contacting your advisor at Centennial and getting a really good recommendation to a general contractor, or working with them. They probably have people that do this all the time and professionally, but trying to do it and manage it yourself is going to be extremely difficult.
So let's talk about that for a second. I'm going to go back to kind of where you started it, but what we've got on the screen is the 10-year Treasury over the last 10 years up top, and then the last year down on the bottom, and we've seen it go up 230 basis points. On the construction debt, have you seen the rates offered by lenders push out at a similar 230 basis points? Have you seen more? Have you seen less? Kind of what are you seeing there?
So I think that they're actually pushing out at a faster rate than the regular lending market, because remember, construction's still speculative, right? And if you can lend on something that's cash flowing, generating income, as a lender, you're more likely to do that on something that doesn't exist that you have to build. I mean, to simplify it, lenders lend money based on, value of the collateral and borrower's ability to repay. Well, if it's a cash flowing asset, the value of the collateral is higher, and then that also assists the borrower's ability to repay. So getting construction debt is not only more difficult, the LTV or LTCs in that case, loan to cost, are going down, but rates are going up faster than they're going up. And there's a lot of banks that are just not even in the market right
now. Thank you for that. Let's talk a little bit about what we're seeing in the market. I'm going to run off some stats or some leading indicators of things that we're seeing, because I think there's a lot of mixed message out there. Certainly, when you look at these graphs, we can see how much interest rates have gone up from the incentive post stay-at-home COVID period to where they're at today, at 3.89%. And we've seen 230 basis points, in the last 12 months. And we've got predicted further increases to the overnight rate in November and potentially December. But beyond that, which is what we see as really kind of a outside pressure on real estate, is in Southern California, we're seeing really strong fundamentals. Industrial vacancy is between about 1.4 and 2.2%, really depending on the submarket throughout Southern California. Rent increases year over year are as much as 8 to 28% in some cases. We've seen the fastest rent growth in the industrial sector. There's plenty of reasons why, and even though there are millions of square feet under development throughout Southern California, the demand for it is still exceeding the production. Jason, you want to make a comment on industrial? You want me to I can keep going through a couple other products and then get your comments.
Yeah, no, I think industrial is a great asset right now. But let's move to the other products. I think we're seeing some really interesting rent items in those places.
Yeah, and the next one I'm going to talk about is retail. There was a time there where everybody thought retail was dead, first Amazon, and then COVID was going to be the death of retail. But what we've really been seeing with our retail professionals is just service tenants are taking over the retail space, really creating, let's call it, one-stop destinations for hair, for a tutoring session, hit the dentist for a teeth cleaning for one of the other kids, maybe drop mom off at physical therapy, and get a workout in while you kind of wait for everybody. The face of retail, the tenant makeup of retail is changing, and correspondingly, we're seeing retail asking rates increase in some markets that have a good synergistic mix of tenants in the center and in the area. On the multifamily side, some other numbers. Vacancy, I think, is between non-existent and probably 4% in the highest areas. And rent increases year over year of 10% or more, depending on where you're at in LA and Orange County. The pent-up demand may be created by the COVID pause period and then the following fear of what to do period. Certainly over the last year and a half, we've been making up for some lost time there, both in occupancy, desire to own businesses, start businesses, get your own place, but also in what people are willing to pay for the space that they're going to occupy. Comments, Jason?
I am just blown away by the rent growth in the multifamily sector. And I think you guys probably are as well. You're underwriting deals all the time for clients getting ready to, list properties or buy properties. The rent growth across Southern California in the multifamily space has just been incredible post-COVID as we come out of it. And I think when many people think about, owning apartments and when is a good time, as we go into a potential downturn ahead or a market slowdown, for example, a lot of people tend to move from home ownership to, renting. So I think you're going to see an increase in the number of, renters, and the supply isn't growing as fast. And so I think it's just going to be a great time where, if you can increase more than 10%, you're probably going to be able to, and I would highly recommend doing so.
And we're going to get into that now because I think that, kind of our opinion or what we've seen, and certainly transaction volume has slowed a bit as interest rates have increased, is that the Federal Reserve and inflation are pushing up that one variable. And that variable shows up in how much you can borrow. It shows up in how much your cash flow can be. And as a result of higher rates, and I think concern of recession, high leverage borrowers or high leverage buyers and syndicators, let's say, relying on unsophisticated money are kind of moving out of the market. And that, coupled with most mom and pop or private client investors that aren't in the real estate business every day, taking a more wait and see approach, that it's really creating a tremendous opportunity for some investors in the marketplace. And over the next 10 or 15, maybe 20 minutes, depending on how long Jason and I talk about it, we're going to go through some of these numbers that kind of showcase the opportunities that people do have today because of the increasing interest rates and maybe the pause or the slowdown of the market. It has created opportunities for certain segments of the investor pool. So the first things that we're going to show you is the United States needs 4.6 million new apartments. They're certainly going to build a lot of them, but as Jason just said, in Southern California, it is very cost prohibitive, and it is very hard to do. Here kind of follows up this graph. What you've got is how do you make it go away for me? Thank you. The blue solid, the new apartments needed. And then if we take annual average construction, how far we're going to be behind by 2030. The demand for apartments is as good as it's been. Vacancy rates, as we just mentioned, very low, and rents increasing significantly. We just had a client who owns a building in Huntington Beach go from $1,750 for a one bedroom to getting $2,300 for that same unit with 5 people wanting it. So there is opportunity when you have the opportunity to increase rent, taking advantage of it is certainly a good thing to do. So that's nationally. What have we heard on a more local level? Is that California needs 2.5 million new homes by 2030. And Jason just told us how hard it's going to be to build, whether it's houses, multifamily, convert a shopping center, a poor laid out, poor located shopping center into housing. It's just going to be really difficult, which is going to put continued pressure on the multifamily sector from a rent increasing standpoint. That, coupled with higher interest rates, as Jason mentioned, and home affordability going down, pushing more people back to the renter pool. So we're pretty excited about what you can see in apartments. We've got a couple here. This is across the board. And I really think Jason and I have kind of echoed this for the first 10 to 20 minutes of this conversation today, is that most people think that there are improving or the conditions are good in real estate. The cost of capital, while it's higher than it was at its low points, we'll show you a slide later that looks at the 10-year treasury over the last 50 years. Still pretty darn good. There are people with some cash out there. There's investors that see the fundamentals, whether it's vacancy levels, leasing activity, and rates as long-term opportunities. Over the last couple of days, we've been asking the question is two questions. Do you think rents are going to go up? And maybe that's a poll that we start right now is question number one. Do you think rents are going to go up? And the other question is 10 years from now, do you think the property values in Southern California or in well-located places across the country are going to be higher than they are today? I'm still looking for a consistent no response to both of those. And we're just not getting them. And here's part of the reason. New renter incomes increased 11.6% year over year. So when tenant fills out their application and they put how much they make, that number across the board has increased 11.6%. Thus, there's more disposable income for rent. So inflation, typically real estate's friend, showing up in wages, also showing up in what people can afford for a multifamily rental or whatever it may be. The marketplace and the fundamentals look awfully strong. Jason, you seen any other numbers that you'd like to share with everybody we've got on the call today, or any anecdotal information from clients about their optimism and where they see opportunity?
Well, I think a lot of people are recognizing that there is a wave of a generation that isn't necessarily interested in home ownership, right? Many of which think that they might rent for an extended period of time, and they like renting places that are nice, and they're happy to pay for a well-located piece of property to rent and to live in. So you have increasing renter pool constantly. You have, increased income, as you stated, and we still don't have that same increase in inventory. I think staying within the multifamily space, and Justin, you made a really good point earlier in the fact that you're going to show the historical trends of the 10-year treasury. We are still highly spoiled, right? Even if we went out and did a new apartment loan today on a buy of a Class B or C building, it's 6%, let's say. That's still historically so low from an interest rate perspective that I know we've more or less just been spoiled over the last couple of years, and we need to think about it as, we were spoiled versus life is going to be difficult. No, I think, for 50 years, people found ways to make money when interest rates were, 10, 11, 12%. We're going to be able to find ways, to be successful when they're 6 or 7 or 8%. And keep in mind too, from the home ownership cost, a year ago, you could get a single family mortgage for most people at 3.5%. Over the last 30 days, the average single family home loan has closed at north of 7.1% interest. That means the same house, if you would have bought it for the same price today versus a year ago, your payment is nearly double. So at that point, maybe, that we would analyze, is it better to rent or buy? Well, now it's heavy on the rent side from a payment perspective.
And I think that's interesting because, for a lot of our clients, a lot of the real estate news they hear is really more centered around the residential market. And while, as you just said, the rates and certainly the teaser rates were lower a year and a half ago for a house, they're now significantly higher than most of the things that we're seeing for investment property. And so there is, I think what we're seeing from all of our data and what we're hearing from the large investors that we work with is that the noise on the residential side is really different than what they're seeing in the fundamental side on investment property. And most opportunities, and we didn't cover office in my earlier comments, but what I would say about office is it feels like, and it seems like people are a little more optimistic about office performance than maybe they would have thought they were going to be 3 to 6 months ago. People are starting to come back to work. Even the biggest, coolest, hippest, employee-friendly, Fortune 500 companies are starting now to really want to see faces again and get people together. So from an office standpoint, even, I think we've got some good things that we're looking into. But it kind of brings us to our next point. So, where is the market? We've seen a bit of a price correction because of interest rates. It affects cash on cash, and it affects somebody's ability to, the amount that they can put into a deal, or the amount that they're required to put into the deal increases. And so we've got a couple pictures here of kind of the things that are available. And Jason always makes a good point, and maybe I'll steal your thunder or I'll lead you into it. But Jason likes to talk about the real estate market like a bus traveling across a city. And why don't you make that point right now, and we'll talk about how it relates to some of these assets that we've got pictured here.
Right. So, I tell people a lot, I use the story that the real estate market's like a bus, and every time the bus stops, people get on and off. And when people get on and off, there's an opportunity to be successful and make money. And right now, I think we're going to see a moment where the bus was traveling at such a high speed that the bus is going to come to a screeching stop, and people are going to have to get off. And if you're available or have the capital or ready to take advantage of the opportunity to get on the bus, I think you're going to be, in for a really great ride going forward, because there are going to be opportunities. And there are these times within the market where, if many, Justin will tell you this because he's been even doing it for longer than I have, that many of our really successful clients, when the market slows down, when the economy slows down, they double down and they buy more instead of less. And so that's when they see the opportunity to really, grow and expand their net worth.
Yeah, and that's kind of the point that we're making here. When you look at this slide, like these properties, South Coast Plaza available today, but no, South Coast Plaza will be available when they decide they want to sell it. I would say that people sell for death, divorce, partnership, breakup. They sell for opportunity. And oftentimes the top of the market or the bottom of the market does not influence that decision. There's a couple properties on here that are brand new construction. Those developers are in the business of developing property, not holding it. They sell it when they complete it so they can go do what they do. A franchisee or a brand that acquires 50 stores that makes burritos or chicken sandwiches really well, they want their capital to go make more burritos and more chicken sandwiches, not tied up in real estate. So there are opportunities in the market where you can get some really great pieces of property at a discount relative to where they were maybe 6, 9, 12 months ago. I would say personally that for Centennial, the quality of our inventory today happens to be the highest quality we've had. It is not the top of the market. It is realistic clients that are selling because they have a reason to sell. And it's just really high quality property. They didn't wait till the market was at the top. They aren't, significantly pressured. It just makes sense for them. And so we're seeing really well located retail with great tenants and long-term tenants. We've got properties in beach cities that are really nice. And because of where the market's at, the clients are prepared to take the market price today. And for some people that are going to be able to pick that up and own these assets that haven't sold in 10, 25, or 50 years, they're going to get their one chance to buy an asset that they're going to hold for all of their lifetime. Any comments on that, Jason, or thoughts in kind of what you're seeing as it relates to the opportunity? The one thing about real estate is it's not a loaf of bread. You can't just go pick up, a commoditized thing. The property by the beach that might be next to your building, the perfect building for your business, some of them are going to be on the market today, and this is going to be the chance and the opportunity. And if the fundamentals are strong long-term and the answer to the poll questions are rents are going to be higher and real estate's going to be worth more, getting them at a discount is not a bad thing.
Right. And I think it's not about getting them at the biggest discount, right? A lot of people try to time the top and bottom of the market. And in reality, if you try to time it right, you're going to miss it. And I think people that are reasonable buyers and reasonable sellers are seeing really good opportunities. I'll use a quick deal example right now. We have a client that's client's a very large family office buying a deal from a very well-known institutional developer in the multifamily space. And we're buying a brand new construction building in LA County for, and a large number, but it's turning out to be a 5.4% cap rate. They have, in order to buy that, they turned around and listed a property that they've done a lot of value add to, really gained in pricing so that they could 1031 from one to the other. And they said to the broker that's helping them on the buy, if you can get me, a good price on the sale, we'll do the buy. they got them a good price. It wasn't the price that they would have gotten, 6 months ago, 9 months ago, or a year on the sell. But again, the big institutional developer is into this deal for about 30 million. They're selling it for about 50. But when they underwrote where they were going to exit it a year ago, they thought it was going to sell for 65. So client as the buyer is getting a big discount from 65 to 50. They might have been able to sell the down leg building that they're selling for 40 for 47 last year. But they think that they're getting so much value on the up leg that the down leg, they're okay, having left some money on the table from 6 or 9 months ago. So
if you can talk a little bit more about that, because oftentimes people get stuck on what they could have got versus all the benefits that they're getting. So in this case, the family that you're working with, although they're not going to get 47 million, why are they moving forward with it? What are the benefits to them in the short term and the long term that make sense today to not get as much as they could for their building and to borrow at higher borrowing costs, but it still makes sense?
So they're transitioning out of a older vintage construction governed by 1482 in a different location, which they had done a lot of value add to, raise the rents a lot, really done a lot to improve the property. And so they're locking in some of their profit there in exchange for a brand new construction building built by a highly reputable institutional developer, not governed by 1482 or any other rent control, in a great market. And so they can project and see much larger rent growth over time. And it's an asset that they would feel comfortable. And I've talked with the head of the family office about this. They're feeling comfortable that this asset could be owned by their great grandkids and still be, functioning and making money, and they'll be really happy with it. And they ultimately know when rates go back down again, even if it's 7 or 8 or 9 years, they'll be able to pull out a real substantial amount of money in a refi because they got this at such a really solid going in cap rate. I think it's about 5.4% cap rate on brand new construction multifamily in LA County. So that's how they're looking at it. And they're just, like you said, Justin, we've talked about this before and you guys have a phrase for it, but, going from an older vintage to a newer vintage, I think you call it gritty to something. I'm missing the phrase, but
we have it in here in a minute. Because we think it is what people should be doing right now before it's too late. And we'll talk about that in a minute.
But Justin, to your point, the seller is selling this nice new building because they're an institutional developer. They are not in the business of holding properties. That big profit that they're making is going to go into 3 new projects that they're going to be doing. And that's their business, right? Their business is to build, not to hold. So that's why those opportunities are becoming available.
To me, that's really the fun time in the market because there's still win-win opportunities for people. For both the buyer and the seller, where everybody benefits and everybody does well for doing the transaction. Jason, you said something really interesting. We'll get into it right here. You talked about that they didn't have to do the deal at the top, or necessarily, the seller didn't have to sell at the top and the buyer didn't have to, and then they didn't have to buy at the bottom. What we're showing you right here is June 2007 to June on the arrow 2009. And why we want to show you this number, this is the cost per foot of property in Orange County, a variety of product types, but this is what the numbers look like from 2007 to 2012. My question for everybody, and Jason, I want you to make the comment, is how did anybody who bought on that arrow, how do you think they feel about their purchase over the last 12 to 14 years? And we'll show you here what that number looks like over the last 15 years. So you don't necessarily need to buy at the bottom or time it perfectly to end up doing really well. You want to add some commentary to that, but it's a pretty amazing slide that speaks to when good real estate is available and you have the chance to add square footage, get a better area, improve cash flow, improve quality of asset, avoid rent control, whatever it may be, even if you don't pick the bottom day, you're going to do really, really well with a reasonable hold period.
Historically, over time, real estate doesn't go down in the United States, and someday it may, but historically it won't. And Justin knows this, and some of you that have attended for a while, like I have a lot of international clients, big international clients, small international clients, and they consistently talk about, and I was on a call with one of them today who Justin actually knows, how the value of real estate in the United States stays strong, because when you look at it as a foreigner, no matter what country you're from, the stability, the safety, the fact that it is yours and the Constitution protects it, and that it's just always going to be a good investment. And hearing it again from someone that didn't grow up here per se in the United States was just a reminder of how strong the market is here in US real estate, and that, that it makes more sense on why when we have a slowdown, all of our really successful clients want to spend more money on real estate than less money. Because if you look at this graph, in 2007, June, everybody thought the world was coming to an end. And if you could go back now and you had a crystal ball, it's like buying Google, when it was, $10 a share, or even came out at $100 a share. Everybody thought it was super expensive. Today you'd be really happy if you held it for 25 years. So
we're going to talk a little bit more. Now we're going to use this graph because, I think if you own real estate, what you want to do is you want to sell high and buy low. And we'll go back one more because I want to get everybody's attention to anybody who did a trade in 2012 through 2021 was selling at the same or lower than what they were buying. And from a return standpoint, from a value standpoint, if they had a good broker who was working hard to find inventory, all those investors have done really, really well. And that was sell low, buy same, or buy higher. We're going to take a little bit of a contrarian approach here and go, right now, maybe as interest rates continue to increase, you actually have the opportunity, especially if you structure the exchange right, to sell high and use the time that you have at your disposal to buy a little bit lower, to go from 10 or 20,000 square feet at 300 a foot to 40,000 square feet at 275 a foot. Not only will you reap the benefits of the long-term rent growth over the additional square footage, but you make a little bit of a value add play. So for those that are wanting to wait and sit on the sidelines, I think in certain cases, there is an opportunity today to use a sophisticated approach to a 1031 to maximize your time and your window to go shopping, where you could effectively have a 6-month difference in the price you pay versus the price you sell. I think we're going to do a few of these, Jason.
I think we're going to do a lot. And I also think people don't realize, but there's a lot of just realism happening amongst sellers right now too. If you're going to be the one buying, where I think a lot of our clients are being really reasonable about where they're looking at things from a sales standpoint. But a lot of sellers, I've seen more retrades in the last 60 days where sellers, when my client was buyer, sellers are like, you know what? My client said, I need a price reduction. They said, okay. Why? Because they're concerned about if they go back out on the market, where they're going to end up anyways. And so they're open to that retrade. But my clients that are selling, that are reasonable about where they're at, and they go in at a good number and are like, you know what, I want to lock in my profit here and look for an opportunity somewhere else, they're doing just fine. The deals are happening. They're still moving. And even if the interest rates stay at where they're at now for 5 or 6 years, remember, your interest rate's going to get fixed. The rents will continue to go up. The income's going to continue to improve. And if you're smart about how you manage your expenses, you're going to end up getting such a good cash flow going forward. When rates go back down, you're going to be able to pull out a ton of money and buy some more deals anyways. So,
Jason, we've been doing probably 20 of these, and we're 44 minutes into this thing, and we forgot to tell anybody that if they have questions, to use the chat to ask us all your questions throughout the whole conversation. If you've had some questions or so you wanted to ask but you didn't about previous stuff that we've talked about, please by all means get caught up. We will answer all those as we go. So we talked a little bit about, let's call it the reasons of why you buy today. And Jason just talked about exactly one of the reasons you buy today is that you kind of have very little downside risk on your interest rate. If interest rates continue to go up and you lock them in today, you've got what you've got. It doesn't go up. If they go down, you do have the potential to refi and either take equity out, redeploy into another property, increase cash flow wherever it may be. So we think that not only are there plenty of good reasons for people to do something, but we think that there's some strategies that really people should be considering. And we're going to show you this next graph. If you've been a part of our talks for a while, it'll look somewhat familiar. As Jason mentioned, this is what we call gritty to pretty. And what you've got there on this chart is the average cap rate in Paramount over the last 30 years, the average cap rate in Torrance over the last 30 years, and the average cap rate in Huntington Beach over the last 30 years. We picked these markets because they are somewhat similar, a good high quality or a good high volume of multi-housing stock, a lot of small office with the occasional tower sort of office setup, major malls in each city, and what I would call a secondary or serving industrial market for the port complex. What do we want you to see is what we found over the last 30 years is that when things are really good, the cap rates get to be pretty much the same. You'll look right in the middle of the graph, 2005, 2006. Everything looked real pretty. 21 and 22, everything looks real pretty. But what we call gritty to pretty and what we suggest for our clients that have built up equity in areas that are lower quality is that when markets change, when interest rates go up, if there's financial and economic challenges, areas of lower quality or property of lower quality more quickly and more dramatically has cap rate adjustments. You can see that in the 94 to 99 period, where although the cap rate for Paramount and Huntington Beach is the same today, and in 06, it was 400 basis points different back in 1998. Even between Torrance and Paramount or Torrance and Huntington Beach, there was a significant push out. So what we've been recommending to clients, or where we think there's opportunity, is that you take assets that are less desirable, lower quality, and you move that money into more resilient markets when things are changing. What's also interesting about this graph is if you overlay this graph with a comparison between the 10-year Treasury and cap rates, typically the times where things are the closest are when cap rates in 10-year Treasury are the closest, like they are today. And then they will push out after those moments, and the grittier areas will get gritty. It's time to move your gritty to pretty before your gritty gets
grittier.
Yeah, grittier. So, Jason, any comment? I mean, I know you've seen these graphs. We've shown them to you before. We've worked with clients that have embraced this regarding their portfolios and repositioned into better areas to be more resilient, to protect their cash flows. We see this a lot in the private client space with people that are in capital preservation and cash flow, where cash flow is the most important thing, like usually in retirement. They can't have the fluctuation. They need stability. But any comments or any additional mentions you want to make here?
Yeah, I wouldn't say this necessarily works for everyone, but like we've done a deal recently where someone had 1031 out of California a handful of years ago into Arizona apartments, made a boatload of money and saw the market moving coming, and 1031 back out of Arizona into a Southern California beach city. So because they were looking for that stability over the next handful of years.
That's a good one. Even within markets, like for example, in Huntington Beach, there's A+ location, A+ building in Huntington Beach. There's older property, less desirable location within Huntington Beach, where somebody who's a very local investor wants to be able to drive by it every day sort of thing, can take their equity that they put into a less desirable or less quality building or location and move a couple blocks, move to a newer building, move to a property that's got the proper clear height, or go from storefront retail to more strip retail, and improve the quality of their asset, which is going to be more resilient in the short-term years ahead. Next one we want to cover, and this one, we'll get into this in just a second, because one of the things to consider, I think, is some blue states, red states, or moving out of state for taxes. But back in 2009 to 2012, we show that graph. Maybe we'll go back to that one right now. Was a period of time where we worked with a lot of clients who had had not refied in the 2000 to 2007 period, and they were sitting on a lot of equity. They had really low property taxes, but they had used a lot of their depreciation, or their depreciation was based on a much lower property value. And with these investors that didn't want to go high leverage, in 2004, 5, 6, and the early parts of 07, they couldn't compete. But once the market changed, I think it was August of that year, and some of the big institutional money players in New York started to go down, and the CMBS market cratered. There was a great opportunity for private clients who had built up a lot of equity to become the best buyer in the marketplace and to get great deals. And what they were able to do was take their large amount of equity, redeploy it into a property that has ultimately made them a lot more money over the last 12 years, and get more immediate cash flow because they got some new depreciation that sheltered more income, and ultimately put a lot more cash in their pocket, set their family up a lot better, and they bought some real high quality, pretty assets as a result. It's the same opportunity today. If looking at this graph, if you could have 20,000 square feet at $350 a foot today, or at $275 a foot today, going to $500 a foot 12 to 15 years from now, we see a lot of similarities in the market, and we see a lot of similar opportunities, especially for investors that are getting near that $5 million mark that Jason had talked about, that we've seen other propositions in California want to tax people on for making money. So we see that as an opportunity as well, as if you are sitting on a large amount of equity, that you have some additional you have some opportunities today that you didn't have, because you don't have to compete with as many people to get great deals. Talk a little bit about going out of state, Jason. We're going to show some stats about money moving out and people moving out, but you've got certainly a national practice, and we've got a lot of friends that have moved to one of those green states over there on the East Coast. Talk about where you see opportunities, or why you see opportunities for people going out of state.
So I think that there's a lot of opportunity because the population growth historically, or movement, had been, from an economic standpoint, not sustainable. Whereas now I think the reason that people moved was for jobs, for opportunities, right? So, there was a lot of, distressed deals in the last downturn in Florida and Arizona and some other places, Nevada. But now you've got people moving for specific reasons. I mean, you look at the Phoenix market, you've got the two largest chip plants in the United States being built there, one in North Scottsdale, one south of Chandler, right? 1 million square feet each. Those all have to be staffed by people. It's opportunities, it's jobs. You look at, Florida, all the jobs that have moved there, been created there. Tennessee, Oracle's building a $2 billion facility in Tennessee. There's some town south of Nashville where GMC is investing $3 billion in an old Saturn plant that they own. So you think about, okay, they're building this for electric vehicles. Well, if you look right next to the Saturn plant, there's a 3,000 acre community being developed. All of that's going to go towards supporting that Saturn plant, right? But then as that community gets developed, people have to open gas stations, car washes, other things. So with all of that job growth in the markets, it means population growth. It'll be sticky and people will stay there. So I think that's why a lot of the opportunity is going to be available.
Yeah, it's starting to be a little different. Certainly when I was younger, I was always moving to California. California was great. But we've seen a lot of businesses leave. And here on this slide, we've just got the numbers to support that over the last few years. 117,000 tax returns lost. That should just be a number, not dollars. There's been almost 20,000, $200,000 returns that have gone out of state. And then California's population declining. Some of these numbers kind of the first times in a long time, or maybe the first times ever. And to Jason's point, it really centers around a lot of these businesses that maybe started in California or headquartered themselves in California have moved to better opportunities. There's also, I think, a lot of private clients that we've worked with. I mean, we've got a friend who made a good chunk of money in California, moved his chunk of money into Colorado, has done amazing there in the Springs, and then taken some additional California equity and redeployed it into some tax-free states through opportunity zones to better position their portfolio. One of the ones we didn't mention that I think is really worth considering today is people who live out of state but still own property in California. There's always been I want to keep my equity in California because California is so strong. It's got X, Y, and Z. Well, all those things are different than what they were 20 years ago. Whether it was, they don't have any rent control, rents go through the roof, it's always growing, et cetera, et cetera. Those were all good reasons to stay in California. Some of those things have changed. Rent control is different. And businesses, as we mentioned, and Jason went through that list, have been leaving. But beyond that, the thing to keep in mind is that there's places, whether it's somebody's home state or a state where they can put their money, that has significantly less state income tax and significantly less state capital gain tax that affects clients. We sat down with somebody the other day and they were able to look at, okay, if I sell my property at a 5 cap, once I'm done with taxes and all the things associated with California, if I go buy myself a 4 cap or a 4.2 cap, I'll make more money. So they're significantly improving the quality of their tenant and the location of their property, and making the same return because they live out of state, and they're avoiding the California state tax. And I think that's something that owners should be considering right now, because some of those drivers and fundamentals that made it worth it to keep your money in California have changed a little bit. Jason, we've got 1 minute and 54 seconds left. You want to talk about opportunity zones at all and what we've been doing and what you've been seeing and some of the changes or exciting stuff that we're seeing from it?
Yeah, we've just been doing a lot of these opportunity zone deals lately. I have to tell you, I still think it's the best investment out there if you have capital gains. The opportunities are fantastic. The property locations are really good. We're finding deals with really solid tenants in them. I mean, 7-Eleven corporate, publicly traded companies in places that we really like. If you have capital gains or if you want to sell a property, and the one nice thing is if you sell some of these properties, you don't have to 1031 anymore, right? If you still have some basis in the deal, you can take that basis and put it in your pocket and have some savings as we go into the future, and then invest your capital gains through an opportunity zone transaction instead, and still own a property and get cash flow and get all the benefits of the opportunity zone without having to stress about the exchange. You actually get a little bit more time to ID the property. So if you're thinking about what Justin said, you time the exchange right and you get 6 months difference, you actually can give yourself even more time. If you sell now and then OZ buy in the future, you can actually give yourself more than 6 months to potentially ride the wave a little longer. So I do think it's a really great opportunity. I think it's a great time to buy. Any property, I think it's a great time to buy, but OZ deals especially. So
It's been interesting. You're talking about you can get them anywhere. I mean, we've got a project we're working on what would you call it, a mile from the ocean in Hawaii, in
Yes.
an opportunity zone. We've got a project under contract right now in the largest industrial park in the world, with a publicly traded corporate tenant on a 10-year lease. The opportunity zones are fantastic, and where we've done a lot of business this year in opportunity zones is with people who had capital gains outside of real estate, seeing the opportunity to get real estate and get a bunch of tax benefits. I think as we move forward into 23 and 24, we're going to see a lot more real estate people taking advantage of it because of some of the things you just mentioned. Wait, I can get my basis out of it and put that back in my pocket and then just redeploy my gains and not have to pay tax on the future gains. There's going to be some great opportunities in opportunity zones. What we'll probably do, since Jason and I had planned on talking opportunity zones and answering questions today, and that we just didn't get to it, and we like to keep this thing to an hour, is we'll schedule a time here in the next couple of weeks where that's what we'll solely focus on. Answering questions about opportunity zones and where we think the opportunities are in the years ahead in that segment of the real estate market. Jason, as always, it's been a pleasure to have you join me. I appreciate your insights. I appreciate your willingness to share them with Centennial's clients. And thank you all for attending.